On the 23rd of September, 1998, the heads of the largest banks in the world were summoned to a room in Lower Manhattan and told that one of them would have to lose money that afternoon. The room was on the 10th floor of the Federal Reserve Bank of New York. The men around the table ran Goldman Sachs, Merrill Lynch, J.P. Morgan, Chase, Morgan Stanley, Bankers Trust, Salomon Smith Barney, and a dozen others. Between them, they controlled the great majority of the world's traded financial assets. They had been brought together to discuss a single hedge fund. Not a bank, not a country. A private investment partnership, 4 years old, based in Greenwich, Connecticut, employing fewer than 200 people. It had no retail depositors, no government guarantee, no systemic role anyone had ever identified. By any conventional measure, it was too small to matter. To put that in proportion, the fund employed fewer people than a mid-sized secondary school, from an office suite in a Connecticut town best known for its golf courses, and the men in that room had concluded it could take the global financial system with it. It had roughly $4 billion of capital at the start of the year. It had borrowed something over $100 billion. And through the derivatives it had written, it had positions with a notional value estimated at more than $1 trillion. Its name was Long-Term Capital Management, and in the previous 5 weeks, it had lost approximately 90% of its equity. The reason the Federal Reserve had convened that meeting was not sympathy. It was that the fund's counterparties, the banks in the room, had discovered that if it failed and its positions were liquidated into the market, they would be liquidating into each other. Every one of them held similar trades. Every one of them would be selling the same things at the same moment to the same absent buyers. The fund's collapse would not be contained by the fund's size. It would be transmitted by the fund's positions. What makes this story worth the next 3/4 of an hour is not the drama of the rescue. It is who was running the fund. Long-term capital management was not a cowboy operation. It was, by some distance, the most intellectually distinguished investment firm that has ever existed. Its partners included 2 men who had won the Nobel Prize in Economics, awarded the previous year, while they were sitting on the board, for the theoretical work that underpins modern derivative pricing. It included a former vice chairman of the Federal Reserve. It included the man widely regarded as the most successful bond arbitrager of his generation, and a trading team recruited from the best desk on Wall Street. They were not wrong about the mathematics. The mathematics was and remains correct. They were wrong about something else. And what they were wrong about is the reason this case is taught in every risk management course in the world. Start with John Meriwether, because the firm was built around him. Meriwether joined Salomon Brothers in the mid-1970s, and by the 1980s ran its domestic fixed income arbitrage group. That desk did something unusual for the era. Rather than trading on views about where interest rates were going, which is essentially guessing, it traded on relationships between securities that ought, mathematically, to hold. Here is the basic idea, and it is genuinely elegant. At any moment, the U.S. Treasury has many bonds outstanding. Some were issued recently, some years ago. A bond issued last month and a bond issued 2 years ago, both maturing on similar dates, are almost the same instrument. They pay similar cash flows with identical credit risk, which is to say none, because both are obligations of the United States government. They should therefore trade at almost exactly the same price. In practice, they do not quite. The newly issued bond, the on-the-run issue, is more actively traded and easier to buy and sell, so investors pay slightly more for it. The older one, the off-the-run, trades a little cheaper. That gap is small, a few hundredths of a percentage point. And it is temporary because as the new bond ages and a newer one is issued, it loses its premium and the two converge. So the trade is, buy the cheap one, sell short the expensive one and wait. When they converge, you close both and pocket the difference. You have taken no view on interest rates. If rates rise, you lose on one leg and gain on the other. What you are betting on is the relationship, not the direction. This is convergence arbitrage, and Merriweather's group at Salomon was extraordinarily good at it. It reportedly generated a substantial share of the firm's total profits. He left Salomon in 1991 in the aftermath of a scandal on the government bond desk that he had not been personally involved in, but which occurred on his watch. In 1993, he began raising money for a fund of his own, and he took most of his old team with him. The scandal is worth a moment because it explains both why Merriweather was available and why a particular investor turned up at the end of this story. In 1991, it emerged that a managing director on Salomon's government bond desk, Paul Moser, had submitted false bids at U.S. Treasury auctions. The Treasury limited any single bidder to a proportion of an auction. Moser had circumvented the cap by entering bids in customers' names without their knowledge, allowing Salomon to corner portions of particular issues. Merriweather was told about one instance and reported it to Salomon's senior management, who then failed to disclose it to the authorities for months. When it broke, the delay was the scandal, not merely the original offense but the concealment. Salomon faced the prospect of being barred from Treasury auctions, which for a firm of that kind is a death sentence. Warren Buffett, whose Berkshire Hathaway was Salomon's largest shareholder, stepped in as interim chairman to save it. He testified before Congress and gave his employees an instruction that has been quoted ever since. Lose money for the firm and he would be understanding. Lose a shred of its reputation and he would be ruthless. Merriweather was not accused of the false bids. He was penalized for the handling, paid a fine and resigned. So when Buffett appeared in September 1998 with an offer for LTCM's portfolio, he was not a stranger to the people involved. He had cleaned up after Merriweather once already. What he added was the theory. Black-scholes and Robert Merton were, with the late Fisher Black, the authors of the intellectual apparatus behind modern derivatives. The Black-scholes model, published in 1973, solved a problem that had defeated everyone before it: how to price an option. An option is a contract giving the right, but not the obligation, to buy or sell something at a set price in the future. Its value clearly depends on how likely the underlying price is to move, but pinning that down mathematically had proved intractable. The insight was that you can construct a portfolio of the underlying asset and cash that exactly replicates the option's payoff, and continuously adjust it as the price moves. If such a replicating portfolio exists, the option must cost what the portfolio costs. Otherwise, there is a free lunch, and free lunches get eaten. That single idea made the modern derivatives market possible. Before it, options were traded on instinct. After it, they could be priced, hedged, and manufactured at scale. It is not an exaggeration to say that a substantial fraction of modern finance rests on that paper. Merton and Scholes joined LTCM as founding partners. In October 1997, they were awarded the Nobel Memorial Prize in Economic Sciences. Fisher Black had died in 1995, and the prize is not awarded posthumously. So the fund launched in 1994 with the strongest possible credentials, and it raised over $1 billion, an enormous sum for a startup fund at the time, on terms considerably more demanding than the industry standard. Investors paid higher fees, accepted a multi-year lockup on their money, and were told almost nothing about the positions. They accepted because of who was running it. The terms are worth stating because they show how much the reputation was worth. Where the industry standard was a 2% management fee and 20% of profits, LTCM charged 2% and 25%. Where most funds allowed quarterly or annual withdrawals, LTCM locked money up for 3 years. Where investors normally receive position-level reporting, LTCM disclosed almost nothing, on the argument, entirely genuine, that its trades could be copied and its edge destroyed. Investors handed over more than $1 billion, on worse terms than they could get anywhere else, to a firm with no track record as a firm, in exchange for less information than they would normally accept. That is what a reputation is worth at the top of the market, and it is a recurring feature of these stories. The strongest credentials do not merely attract capital, they suspend the ordinary questions. The strategy was Merriweather's convergence trading, applied across a far wider range than any single bank desk had attempted. Not just U.S. Treasuries, but Italian government bonds against German ones, mortgage-backed securities against treasuries, corporate bonds against government bonds, equity volatility, merger arbitrage, on the run against off the run in half a dozen countries. It is worth walking one of these trades concretely, because the phrase relative value conceals how odd some of them were. Take the Italian convergence trade, which was among the fund's largest and most profitable. Through the mid-1990s, Italy was preparing to join the euro. Italian government bonds yielded considerably more than German ones, reflecting decades of higher inflation, repeated devaluation, and a general belief that Italy was a riskier borrower. But if monetary union happened, both countries would share a currency and a central bank. The currency risk that justified much of the gap would simply cease to exist, and the yields would have to converge. So the trade was, buy Italian bonds, sell German bonds, wait for the euro. If union happened, the spread collapses and you profit enormously. If it did not happen, you lose. Notice that this is not really arbitrage in the strict sense. There is no mathematical relationship forcing convergence. It is a bet on a political outcome, dressed in the language of relative value, and the fund was heavily exposed to it. That trade worked. Monetary union proceeded, the spread narrowed, and LTCM made a great deal of money. But it illustrates something about how the strategy drifted. The original Salomon trade, on the run against off-the-run treasuries, really was close to riskless arbitrage. Two almost identical instruments, one temporary distortion, a mechanical reason for convergence. As the fund grew and the easy spreads compressed, it moved into trades where convergence depended on judgment, on politics, or on markets remaining orderly. Those still looked like the original strategy on a risk report. They were not the same animal. The unifying logic was the same everywhere. Find two things that should be priced identically and are not. Buy the cheap, sell the dear, hold until the relationship reasserts itself. The models told them how big each gap was in historical terms, how unusual, measured against decades of data. When a spread was wider than it had ever normally been, that was a signal, because spreads revert. And here is where the trouble begins, though nobody could see it yet. The profits from convergence trading are tiny. The gap between two nearly identical bonds might be 1/10 of a percentage point. On $1 million, that is $1,000. Nobody builds a firm on that. So you scale it. If you can borrow the money, you put on the same trade in size, $1 billion instead of $1 million, and the same 0.1% becomes $1 million of profit. It is worth being concrete about how the borrowing actually worked, because leverage 25-to-1 is a phrase people repeat without picturing the mechanism. The instrument was the repurchase agreement, the repo. In a repo, you sell a security to a counterparty and simultaneously agree to buy it back shortly afterwards at a slightly higher price. Legally, it is a sale and repurchase. Economically, it is a secured loan, with the security as collateral and the price difference as interest. The critical variable is the haircut, how much less than the securities market value the lender will advance. On U.S. Treasuries in the 1990s, haircuts were very small. A lender might advance close to the full market value because the collateral was considered riskless and instantly saleable. A small haircut is enormous leverage. If a lender advances 99% against a bond, $1 of your own capital supports $100 of position. Do that across a portfolio, and 25-1 is not aggressive. It is a natural consequence of the financing terms available. And LTCM negotiated hard on those terms. Its reputation was such that it obtained financing on conditions other funds could not, in some cases with no haircut at all, and with fee arrangements and collateral terms that assumed the fund's own risk assessment was correct. Now notice what that does to a falling market. Repo is short-term. It rolls over constantly, often overnight. Each time it rolls, the collateral is revalued. If the security has fallen, the lender advances less against it, and the borrower must find the difference in cash. If the lender becomes nervous, it raises the haircut, and the borrower must find that difference too. So leverage is not a fixed quantity you choose. It is a variable your lenders control, and they tighten it in exactly the circumstances where you can least afford it. A fund financed at 99% in calm markets can find itself financed at 90% in stressed ones, which means finding an enormous sum in days. This is leverage, and LTCM used it on a scale that had no real precedent outside banking. At the start of 1998, the fund had roughly $4.7 billion of its own capital and had borrowed well over $100 billion. Balance sheet leverage of something in the region of 25-1. And the balance sheet did not capture the derivatives, whose notional exposure has been estimated above $1 trillion. Now, the partners were not unaware of this. Their argument was precise and worth stating fairly because it is not obviously wrong. Leverage is dangerous in proportion to the volatility of what you hold. A 25 times leveraged position in a single volatile stock is insanity. But LTCM was not holding directional positions in volatile assets. It was holding hundreds of hedged pairs, each with tiny volatility, spread across dozens of markets and several continents. The model said the portfolio's overall risk was modest because the positions were diversified. Italian bond spreads and American mortgage spreads and Japanese equity volatility had nothing to do with each other. Historically, they had moved independently. A loss in one would be offset by gains elsewhere. Diversification allows leverage. That is not a fallacy. It is the foundation of portfolio theory, and it is correct as far as it goes. The returns were spectacular. After fees, the fund returned something over 40% in 1995 and again in 1996, and around 17% in 1997. On the capital deployed, this was among the best records in the industry, achieved with what appeared to be low volatility. At the end of 1997, the partners did something that reads very differently in hindsight. They returned money to investors. About $2.7 billion of outside capital was handed back, on the grounds that the opportunities available were not large enough to deploy it profitably. That judgment was correct. Convergence opportunities had narrowed, partly because everybody had noticed the strategy and copied it. Every major bank had established a proprietary desk doing something similar, and competition had compressed the very spreads LTCM lived on. But returning capital, while keeping the positions, has an arithmetic consequence. The equity base shrank, the borrowing did not. Leverage rose. The fund entered 1998 with less cushion and the same exposure, in markets where its edge had thinned and its trades had been widely replicated. There had already been a warning, and the fund read it as an opportunity. In the summer of 1997, the Thai baht collapsed, and the crisis spread across East Asia, Indonesia, South Korea, Malaysia, the Philippines. Currencies fell, banks failed, the IMF arrived with programs, and capital fled the region. For a convergence fund, this looked like exactly the right environment. Panic widened spreads. Widened spreads are the raw material of the strategy. The wider the gap, the greater the profit when it closes. LTCM's models reported that many relationships had moved several standard deviations from their historical norms, which by the logic of the models meant the trades had never been more attractive. So the fund leaned in. It increased positions into the dislocation, on the reasoning that had served it for 4 years and for Merriweather's whole career. That reasoning contained a hidden clause nobody had written down. Buying a widened spread is a bet that it will narrow. But it is also, unavoidably, a bet that you will still be there when it does, that you can finance the position through however long the abnormality lasts. Through 1997 and early 1998 that held. Spreads did narrow, the fund did profit, and the experience confirmed the approach. Dislocation is opportunity. Hold your nerve, wait for reversion. It is worth naming what that confirmation actually did. It was the last successful test before the fatal one, and it made the partners more confident and more leveraged going into the year that killed them. A strategy that works through a moderate crisis teaches you that it works through crises. Then Russia defaulted. On the 17th of August, 1998, the Russian government devalued the ruble and defaulted on its domestic debt. This was, in strict financial terms, a modest event. Russia's economy was smaller than the Netherlands. The affected debt was ruble-denominated, held substantially by Russian institutions. What mattered was not the size, it was the category. Sovereign governments were not supposed to default on debt in their own currency. A state that controls its own printing press can always, in the narrow mechanical sense, pay. When Russia chose not to, it did not merely impose losses on the holders of Russian debt. It falsified an assumption that had been embedded in how everyone priced everything. What followed is the phenomenon the entire episode turns on. It is called flight to quality, and it is worth being precise about what it does. When investors become frightened in a specific way, not about a particular asset but about whether they can get out of anything at all, they do not rebalance. They liquidate. Everything that is not the safest, most liquid instrument available gets sold, and the proceeds go into the one thing everyone agrees can always be sold: on-the-run U.S. Treasuries. Now apply that to LTCM's book. The fund was, in nearly every trade, short the expensive liquid instrument and long the cheap illiquid one. That is what convergence trading is. You sell what people are overpaying for and buy what they are ignoring. In a flight to quality, the price of liquidity goes up, which means the expensive thing gets more expensive and the cheap thing gets cheaper, in every market simultaneously. Every spread the fund held widened, not some, not most, essentially all of them. And the reason is the thing the models had not captured. The positions looked diversified because they were in different countries, different asset classes, different instruments. But they were not independent bets. They were the same bet, expressed dozens of ways, a bet that the premium for liquidity would not rise sharply. When that single underlying factor moved, every position moved with it. Correlations that had historically been near zero went, in the language of the trade, to 1. The mathematics of what happened next is brutal and simple. A portfolio's risk under diversification assumptions is far lower than the sum of its parts. Remove the diversification, and the risk is the sum of its parts. LTCM was leveraged 25-1 against a risk estimate that had assumed independence, and independence had just disappeared. The fund lost around $550 million on a single day in late August, over 15% of its remaining equity. By the end of that month, it was down 44% for the year. And then the second mechanism engaged, which is the one that turns a large loss into an existential one. Everybody knew the positions. Not the details, but the shape. LTCM's strategies had been imitated across Wall Street, and its counterparties, the banks financing it, could see substantial parts of its book because they held the other side. When it became apparent that the fund was in trouble, other participants understood exactly which positions would have to be sold. So they sold first. Some traded ahead of the anticipated liquidation deliberately. Others were simply reducing the same exposures for their own reasons, having their own bad month in the same trades. The result was that LTCM's positions moved against it precisely because it held them. Every attempt to reduce a position pushed the price further against the remainder. The fund was too big for the market it had built its business on. This is the difference between being wrong and being illiquid, and it is the central lesson. The partners' analysis was not incorrect. The spreads did eventually converge. Every major position LTCM held to maturity, have made money, and the banks that took over the portfolio did in fact recover their investment over the following years, precisely because the trades came good. But the fund did not have until eventually. It was financed by short-term borrowing secured against those positions, marked to market daily. When the marks moved against it, lenders demanded more collateral. Meeting those calls required selling. Selling pushed prices further, which produced more calls. Being right about the destination is worthless if you are forced to sell at the bottom of the journey. Solvency is a statement about assets and liabilities. Liquidity is a statement about timing. LTCM was arguably solvent and definitively illiquid, and only one of those two conditions has to fail. By late September, the fund's equity had fallen from around $4.7 billion at the start of the year to a few hundred million, against liabilities still measured in the tens of billions. There is one aspect of this that distinguishes LTCM from most financial disasters, and it should be stated in the partners' favor. They were not playing with other people's money while keeping their own safe. The partners had a very large proportion of their personal wealth invested in the fund, reportedly the great majority of it, and several had borrowed to increase their stakes. When the fund lost 90% of its value, they lost their own fortunes alongside their investors. That matters for how you read the story. The standard critique of financial risk-taking is that the incentives are asymmetric. The trader takes the upside, and somebody else carries the downside. Heads I win, tails you lose. It is a good critique, and it applies to a great many episodes. It does not apply here. These men believed their models. They demonstrated that belief in the only way that is not cheap, by putting their own money behind it, and they were ruined. Which makes the failure more interesting rather than less. If the disaster had been driven by people gaming their incentives, the remedy would be obvious: fix the incentives. LTCM shows that you can align the incentives perfectly, have the decision makers bear the full downside, and still get the catastrophe, because the error was not in what they wanted. It was in what they believed about how the world behaves. You cannot fix a wrong belief with a bonus structure. Skin in the game disciplines behavior. It does nothing whatever to correct a shared assumption that everyone in the room, including the person risking their own house, holds with complete sincerity. It is also worth walking the final weeks, because the speed is the part that is hard to convey in summary. At the end of July 1998, the fund was down about 15% for the year. Uncomfortable, not alarming, and consistent with a difficult period in a strategy that had delivered for 4 years. Russia defaulted on 17 August. Within 4 days, the fund lost over $500 million, around 15% of what remained, in a single session. By the end of August, it was down 44% for the year. Merriweather wrote to investors early in September acknowledging the losses and seeking new capital. That letter inevitably leaked, which converted a private problem into a public one, and told every trading desk in the world that a large holder of well-known positions was in difficulty and might have to sell. Through the first 3 weeks of September, the fund lost money almost every day. Attempts to raise capital failed. Approaches were made to a range of potential investors, including George Soros and others, and none closed. Attempts to sell parts of the portfolio failed too, because the only buyers who understood the positions were the same firms that held them and were themselves reducing. By 21 September, the equity was down to a few $100 million against tens of billions of liabilities. 2 days later, the meeting was held. 6 weeks from an uncomfortable year to the edge of a systemic event, which is how the Federal Reserve Bank of New York came to be hosting a meeting. The Fed's concern was specific, and it was not about the investors, who were sophisticated adults who had accepted a risk. It was about what a forced liquidation would do. If LTCM defaulted, its counterparties would seize the collateral and sell it, all of them at once, into markets that were already stressed and already short of buyers. Each bank in that room held similar positions on its own book. The liquidation would drive prices against those positions too, generating losses at institutions that had nothing to do with the fund. That is contagion, and it does not require anybody to have been reckless. It is the same structure as a bank run, with one difference that makes it harder to stop. In a classic run, depositors withdraw because they fear other depositors will withdraw first, and the remedy is deposit insurance. Remove the reason to run, and the run stops. Here the runners were not depositors but counterparties seizing collateral, and there is no insurance for that. Each bank's decision to sell first was individually correct and collectively ruinous, and nothing in the system existed to coordinate them, which is precisely the gap the Fed stepped into by putting them in one room. It is worth being clear about what the alternative actually looked like, because systemic risk is a phrase that gets used to justify a great deal and deserves examination in each case. The Fed staff spent the days before the meeting trying to establish something basic. What would happen if the fund simply defaulted? And they found they could not answer it, which was itself the answer. Nobody had a consolidated picture. LTCM's counterparties each knew their own exposure to the fund. None of them knew the total, because there was no reporting requirement and no central record. Several major banks had extended credit on the assumption that they were one of a small number of relationships, and were surprised to learn how many others there were. Worse, the collateral each held was concentrated in the same instruments. In a default, each would sell what it held, and the sales would be simultaneous in the same securities into a market with no natural buyers, at a moment when everyone was already reducing risk. The first seller might realize something close to the marked value. The last would realize very little, which creates a race. And a race to liquidate is precisely the mechanism that converts one firm's failure into everyone's losses. So the case for intervention was not that LTCM deserved saving, or that its investors should be protected. It was that the process of unwinding it in a disorderly way would impose losses on institutions that had nothing to do with the fund, through a chain nobody could measure in advance because nobody had the data. Reasonable people disagreed at the time and still do. The counterargument is straightforward and serious. A rescue, even one funded privately, tells the market that a sufficiently interconnected firm will be helped, and that expectation encourages exactly the interconnection that made the rescue necessary. If moral hazard is real, it was created that afternoon. The Fed's response is worth understanding precisely because it is routinely mischaracterized. It did not lend money. It did not guarantee anything. It did not spend $1 of public funds. What it did was convene the meeting and apply pressure. It made the room confront a collective action problem. Every bank would prefer that somebody else recapitalize the fund, but all of them would suffer if nobody did. There was a competing offer. A consortium led by Warren Buffett's Berkshire Hathaway, with AIG and Goldman Sachs, proposed to buy the fund's portfolio outright, offering a small sum for the partnership itself and injecting substantial new capital. The terms would have wiped out the existing partners almost entirely. It was communicated under time pressure, and for reasons that remain disputed, was not accepted. So the banks did it themselves. 14 institutions put in roughly $3.6 billion in exchange for 90% of the fund. The existing partners were left with a token stake and no control. The portfolio was managed down in an orderly way over the following period, and the consortium got its money back. The Federal Reserve also cut interest rates 3 times that autumn, which is sometimes cited as part of the rescue, and was really a response to the broader conditions the crisis had helped create. It is worth knowing what happened to the people, because the sequel is part of the argument. John Merriweather did not retire. In 1999, less than a year after the collapse, he founded a new fund, JWM Associates, running a strategy recognizably descended from the old one at lower leverage. It raised money without apparent difficulty, a fact that says something about how Wall Street actually assesses track records. JWM performed reasonably for most of a decade. Then in 2008 and early 2009, in a crisis with the same structure as the one that had destroyed his previous fund, it lost around 40% and was wound down. He started a third fund in 2010. Black-scholes and Robert Merton returned to academic and advisory work and remain figures of enormous standing, which is appropriate. The Black-scholes-Merton framework is a genuine and permanent contribution, and its author's involvement in a failed hedge fund does not diminish it. The prize was awarded for the theory, and the theory is right. What failed was not the option pricing model. It was the risk model built on top of it, the assumption that the distribution of outcomes observed in the past describes the distribution of outcomes available in the future. That distinction matters, and it is regularly lost. Black-scholes tells you what an option is worth given a volatility. It does not tell you that volatility will stay where it has been, and it never claimed to. The banks that rescued the fund made money. The consortium's $3.6 billion was returned in full with a profit as the positions converged, exactly as the partners had predicted. Over a timescale the partners could not survive. That is the single most instructive fact in the whole episode. The trades were right. The analysis was right. The people who eventually collected the profit were the ones with balance sheets deep enough to wait. Being correct is a claim about the world, Surviving is a claim about your financing. So what should be drawn from it? The first lesson is about models, and it is more subtle than model bad. The models were not wrong, they were conditional. Every risk estimate LTCM produced was correct given its assumptions. That historical relationships would continue to hold, that correlations would stay near their observed levels, that markets would remain liquid enough to exit. Those assumptions were reasonable, and they were derived from real data. What they could not capture was that they would all fail at the same time, because they all depended on a single hidden variable, whether the market was functioning normally. A model calibrated on data from normal periods tells you about normal periods. It has nothing to say about the abnormal ones, because by construction those are the observations it has least of. And the abnormal ones are the only ones that can destroy you. There is a specific technical version of this worth stating, because it is the thing that actually did the damage. Risk models of the era described market movements using the normal distribution, the bell curve. It is mathematically convenient. It fits ordinary market noise reasonably well, and it makes the equations tractable. It also assigned vanishingly small probabilities to large moves. Under a normal distribution, an event 5 standard deviations from the mean should occur roughly once in several thousand years. A 10 standard deviation event should never occur in the lifetime of the universe. Financial markets produce such events every few years. The distributions have what statisticians call fat tails. Extreme outcomes are far more common than the bell curve predicts. Everybody in quantitative finance knows this now, and a good many knew it then. Benoit Mandelbrot had been making the argument since the 1960s, using cotton prices, and had been substantially ignored because his distributions did not permit the neat closed-form solutions the industry had built itself around. The consequence is not academic. A model that underestimates the frequency of extreme moves will tell you that a given amount of leverage is safe when it is not, and the error is largest exactly where it matters most, in the tail, where the firm dies. LTCM's partners were sophisticated enough to know about fat tails. What they underestimated was not the possibility of a large move in one market. It was the possibility of large moves in every market at once, which is a different failure, not the shape of one distribution, but the collapse of independence between many. The second lesson is that diversification is not a count of positions. It is a count of underlying bets. LTCM held hundreds of positions across dozens of markets, and it held approximately one bet. The apparent diversification was a description of the instruments, not of the risk. The third is the one about liquidity and time, and it is the one traders repeat to each other. Markets can remain irrational longer than you can remain solvent. LTCM was eventually right and was destroyed before eventually arrived. And the fourth is the uncomfortable one. LTCM happened in 1998. It was investigated, written about at length, taught in business schools, and produced a genuine improvement in how banks measured counterparty exposure. Every lesson above was available, in print, in detail by 2000. 8 years later, the global financial system produced a crisis with the same structure at a scale 2 orders of magnitude larger. Institutions leveraged against models calibrated on benign data. Positions that appeared diversified and shared a single hidden dependency. In that case, the assumption that house prices do not fall nationally at the same time. Correlations going to 1. Liquidity vanishing precisely when it was needed, counterparties who all held the same trade. The specific instruments were different and the numbers were vastly bigger. The failure was identical. And there is a specific episode in between that makes the failure harder to excuse, because somebody saw it coming and said so, in public, in the same year. Brooksley Born was chair of the Commodity Futures Trading Commission, the regulator responsible for derivatives. In May 1998, 3 months before Russia defaulted, her agency published a concept release, a document asking whether over-the-counter derivatives, then a largely unregulated market of enormous and unmeasured size, should be brought within a regulatory framework. It did not propose rules, it asked questions. Should there be reporting requirements so that somebody knew the size of the exposures, capital requirements, record-keeping standards? The reaction was extraordinary. The chairman of the Federal Reserve, the Secretary of the Treasury, and the chairman of the Securities and Exchange Commission publicly opposed it. They argued that raising the question created legal uncertainty that could itself destabilize the market, and that sophisticated institutional counterparties did not require the protections retail investors need. Congress was asked to prevent the CFTC from acting and passed a moratorium on its authority in this area. Then, 4 months later, a hedge fund with $1 trillion of derivative notional and no reporting obligation to anybody nearly took the system down, and the Federal Reserve had to put 14 banks in a room because nobody, including the counterparties, had a complete picture of the exposures. That should have settled the argument. It did not. Born left the CFTC in 1999. In 2000, Congress passed the Commodity Futures Modernization Act, which explicitly excluded most over-the-counter derivatives from regulation, and did so with broad bipartisan support. The market that was left unmeasured and unreported went on to grow through the 2000s into the credit default swap complex, which is the instrument that transmitted the mortgage losses through the system in 2007 and 2008. Alan Greenspan later told a congressional committee that he had found a flaw in his model of how the world worked, that he had assumed firms acting in their own self-interest would be best placed to protect their shareholders, and that the assumption had proved wrong. That is a considerable admission, and it was made 10 years late, which suggests the lesson was not really learned, and it is worth asking why, because the answer is not stupidity. It is that the incentives run the other way. A firm that assumes correlations may go to one must hold far more capital and take far less risk, which means lower returns in every year that the assumption is not tested. Competitors who make the optimistic assumption will outturn it year after year, for as long as conditions stay normal. Investors and boards will notice. The prudent firm underperforms for a decade and is vindicated in a fortnight. That is not a payoff structure that selects for prudence, and no amount of teaching the LTCM case changes it. Which is perhaps the real lesson of the room on the 10th floor of the New York Fed. The people around that table were not fools, and neither were the men whose fund they were rescuing. They were the most capable and best-informed participants in the market, and the system they collectively operated had produced an outcome none of them wanted, and each of them had rationally contributed to. 2 Nobel Prizes were not enough, because the problem was never a shortage of intelligence. If anything, the intelligence was the hazard. A less capable firm could not have built a portfolio that complex, could not have obtained financing on those terms, and could not have persuaded sophisticated counterparties to extend that much credit on the strength of a risk model. Every door that opened to LTCM opened, because the people involved were exceptional. The fund was not destroyed, despite the quality of the people running it. It reached the scale required to threaten the system because of it.